welcome to the Glenn Show. This is Glenn Loury of Brown University and bloggingheads.tv, and I'm very happy to be talking today with Professor Laurence Kotlikoff of Boston University, economist extraordinaire and expert on many things, including banking, finance, and regulatory reform and all that kind of stuff. So glad to be with you today, Larry.
Hey, Glenn, I think my best title is your buddy. So.
Oh, man, thank you. Agreed. I'm proud to count you amongst my friends as well. Yeah. So, Larry, I wanted to talk with you about the Libor banking scandal, Libor. You've recently instructed me that it's not Libor, it's Libor. And I've been reading about this Barclays Bank and all of this, some kind of non-transparent setting of interest rates by bankers to enrich themselves. And although I have a PhD in economics, and I've been teaching economics for 30 years plus, I still don't really understand what's going on. I thought that you might be able to help me and the viewers of the Glenn Show out by, walking us through, just what is this London interbank overnight lending rate all about? Why is there a scandal? Why is it important? And, what do you think should be done about this kind of situation? So, I don't know. You feel like talking about that?
Absolutely, yeah. Let's do it.
Okay.
Well, Libor is calculated as an average of the rates that big banks charge each other to borrow money. And the reason this interest rate is this average interest rate is particularly important is that it's used in determining how, for example, adjustable rate mortgages should be adjusted from year to year or day to day, depending on how they're set up. And there's lots of other contracts that are written as a function of, as depending on the Libor rate. So if the Libor rate is being rigged by the banks, as it clearly has been done, then people are going to have their mortgage rate be set too high or too low relative to what was appropriate. Or some interest rate swap, some derivative contract is going to be settled or basically settled at the wrong prices or adjusted to the wrong prices, so that somebody's going to get hurt, somebody's going to get helped. And this market that's involving Libor is absolutely enormous. It's in the hundreds of trillions of dollars.
Okay, let me just stop you there for a moment. So the Libor is an average of rates that banks are supposed to be paying in order to borrow money from each other, which average is entered into a variety of contracts that people make with one another, that is, a homeowner might make with a mortgage lender, which contracts stipulate that the payments are supposed to be adjusted according to, quote, the interest rate, close quote. But of course, there isn't any one interest rate. But this average is a reference point that many contracts use to specify what, quote, the interest rate is. And it's a changes requiring adjustments in the payments that people are making, as, for example, the payments they make on an adjustable rate mortgage. Do I have that right?
Yes, exactly. You said it better than me for sure.
Okay, now, so my question is, why refer to something, London interbank overnight lending? Why not, if I have a mortgage with Citibank, why not just look at the interest rates that Citibank is paying and have my mortgage interest adjusted according to that, as opposed to something that's being set in London or something?
Yeah, I don't actually understand the history of how this was set up, but what you're saying is, why not make the Libor something that's publicly observable? Why have this opacity where it depends on the bank's reporting?
Exactly. That's what I am saying. Why can't I pick up the Wall Street Journal in the morning and go to some complex table and figure out what today's interest rate is or something like that, rather than waiting for bankers to tell me what it is?
Yeah. I don't know, except the only thing I can say is that this is not uncharacteristic of the way the entire industry operates. They like to keep us in the dark. They like to keep their secrets. And they like to operate with proprietary information. So the more secrets they keep, the more they can manipulate things. I'm not saying they, this is some grand conspiracy where the hundreds of thousands of bankers in the world get together every morning at 4 a.m. and plot what to do. But this it's endemic proprietary information opacity that's endemic, and that's really the major cause, or one of the two major causes of our ongoing financial crises.
Okay, well let's get to that, but we haven't quite finished explaining what is going on with Libor and where the scandal is coming from. So anyway, we have this index of interest rates which are used in, you say, trillions of dollars of contracts. So explain that. That seems like an awful lot.
Well, yeah, from what I've been learning, there are hundreds of trillions of dollars in the derivatives market. So I actually think that the size of the derivatives market right now is, as reported by the Bank of International Settlements, is somewhere close to $600 trillion.
These are contracts, derivatives are contracts that are written between people, the terms of which depend on what is happening on some other financial instrument, and that's why they're called derivatives. They derive their meaning from what happens to another financial asset.
Right.
And you say so 600 trillion. This is the worldwide, this is the estimated magnitude of these derivative contracts.
Yeah, and a lot of these things this is the gross volume, so you could have Party A and Party B could have a lot of different derivative contracts, and in some state of the world, Party A gets paid off, but on some of its contracts, but on others, Party B gets paid off, so that this is a gross figure, not a net figure, but it's astronomically large. U.S. GDP is only $15 trillion in comparison. So we're talking about not all the derivative contracts being pegged to Libor, but perhaps $100 trillion. I've seen estimates as large as $300 trillion. But even if we're a trillion, that's an enormous number. Because what it connotes is that, or suggests, is that there can be ongoing lawsuits, because anybody who's got a contract that's pegged to Libor is going to be able to find potentially that he lost money or she lost money as a result of this rigging of Libor. So it's not just the government settling with these banks that is causing their stock market prices to drop. It's also the overhang
prospective
of
lawsuits
huge
that might come
lawsuits.
down. Okay, can you give us an example? You say derivative contracts. Now, I'm, in my naivete, assuming that these are contracts that a company or investment fund or a bank might enter into to try to insure themselves against something. That is, they're betting that if the interest rate moves this way, then Party A pays Party B, because Party B stood to lose if the interest rate would have moved that way, and entered into this contract in order to hedge that risk. Is that intuition on my part correct? And if so, can you give us a concrete example of what such a contract might be?
Okay, well, maybe like Brown University might take a swap agreement. It's worried about having to borrow money. Maybe it's borrowing some money and it doesn't want the interest rate to go up on it. So maybe it's got a loan that is renewable at the current prevailing rate. It's an adjustable rate loan, and they make some agreement with some investment bank, let's say, that if the interest rates go above a certain level, the investment bank gives them insurance, doesn't make them pay anything more than that ceiling. So, maybe this is it could be a case where the LIBOR kicks one over the ceiling and the investment bank has to kick in money to Brown University, let's say, on this contract. Well, the investment bank has shareholders. The shareholders just had to pay out more money
Yep.
to Brown University, so they got hurt, and they could potentially sue Barclays, a different bank that has rigged Libor. I just don't know all the potential damages here and claimants. But
yeah, no, I wouldn't expect you to give me a
seems,
complete map of the terrain, but just illustrating one concrete thing was helpful. So
Yeah, sure.
let's talk about the rigging. I also don't get this. I mean, as you say, there are a large number of banks in the world, and I don't understand how one or two institutions could materially influence an average of the rates that all these banks are paying by
it's only about 12.
Yeah.
Well, it's only about 12 banks that are involved, I believe, in setting Libor. So it's only the borrowing rates of about 12 banks that are averaged together, and these are the large banks. And if a trader can move at Libor just a really small amount, and he's got some huge trade, which depends on the exact value of Libor, he can make, maybe he can make a couple extra $1,000 this morning, in the next hour, just by
moving it
manipulating things a little bit.
A couple of basis points one way or the other.
Right. So that's the kind of thing. It may be that this is not such a huge thing, that there weren't that many parties that were dramatically affected, but frankly, I think that at least during the crisis in 2008, Libor could well have been off by 200 basis points, namely
that's 2 percentage points. That's the difference between a 4.5% and a 6.5% mortgage interest rate.
Yeah, I don't know. Maybe that's just an uninformed guesstimate.
But how is this rigging happening? I mean, you say they are. There's a scandal that's going on. People are going to be sued. What's going on? I mean, just the mechanics of how the banks report their rates and how the rigging could actually happen. I'm not sure I understand that either.
Well, I think Barclays and these other banks had to report on a daily basis what their borrowing rate was. And so they may be collecting the guy inside Barclays who's figuring out what he should be telling this central group, that who's ever collecting the information from the 12 banks.
And is this group, by the way, excuse me, is it a private group that collects this information from the banks, or is it some like Bank of England or Federal Reserve entity that is getting this information from the banks?
I think it's just a private group of banks that put out this piece of information, and that's my understanding. Of course, the Bank of England and other regulators are deeply concerned and have been involved in this problem, because Barclays is claiming that the Bank of England was putting pressure on it at some point to actually rig Libor, to report a lower value than was appropriate, than they were actually paying, and in order to calm the markets and not show that Barclays was in bad shape. And the Bank of England denies this. The head of Barclays, who just resigned, Bob Diamond, claims that he was given some signals or some winks that he should do this. But,
he said that publicly.
Yeah, he testified. Now, he wasn't actually. He testified that he wasn't actually told to rig Libor. That he was told that there were people concerned in the Parliament and other parts of the British government that Barclays' borrowing rate was higher than was unusually high. And was this true? And somehow this message that was conveyed to Bob Diamond from Paul Tucker at the Bank of England, who's maybe the second in command at the Bank of England, and Paul denies that there was any implication that Barclays should change its Libor reporting. Anyway, somehow Bob Diamond says that what he heard from Paul Tucker was misheard by his chief operating officer, who then went ahead and apparently significantly rigged Libor on the basis of some whisper down the lane.
Okay, hold on. I want to make sure I'm following. The word out from, at least reading the tea leaves from Bob Diamond, is that the Bank of England encouraged Barclays to understate its borrowing cost because that would allow Barclays' overall financial position to look stronger than it otherwise would have looked, and the Bank of England had an interest in not seeing there be a run on Barclays, something like that.
Well, what Diamond actually said was that he got a call from Paul Tucker, and Paul Tucker said that there were highly placed members of the British government who were raising concerns about Barclays' Libor borrowing rate as being, and that he just wanted to give Bob Diamond a heads up that people were starting to raise eyebrows about Barclays' financial position. And when Bob Diamond conveyed this to his COO took that to mean that the Bank of England wanted Barclays to underreport its true borrowing costs. Now, Paul Tucker denies that this actually was what he said exactly, and that
I see. Okay.
So there's a lot of
without going into the hearsay. So here's what I don't understand: how could it be in a bank's interest to underreport its borrowing costs? If they're rigging, it sounds like they were rigging down, that is, reporting lower than their actual costs.
Yeah.
Now I can see how somebody somewhere might lose money that they wouldn't otherwise have lost because of that understatement. But I don't see how the bank gains from telling people that it's paying less for borrowing money overnight to manage its affairs than it's actually paying. It seems like they want to overstate their borrowing costs in order to rig the system in their behalf.
Well, it depends. All these banks have big both long and short positions. Short positions is where you're betting something, a price goes down as opposed to going up, where you make money if the price goes down. So they may have had positions outstanding where they made money if they were betting that interest rates were going to be lower than they actually were. I'm not. It could well be that this entire rigging of Libor, to the extent that Barclays engaged in it, didn't actually help Barclays' profitability. It may have just helped the book of particular traders within Barclays.
Yeah.
Some people within Barclays might have overly influenced Libor, and other traders got hurt right within Barclays because these guys are like independent entities. The main thing is that you have this very highly paid CEO Bob Diamond, who's supposed to be a fantastic executive, and you've got traders screaming on the floor that they're rigging Libor, where it can be overheard by a lot of people. And
screaming, you mean to say bragging that they're rigging it, or?
Yeah, they're bragging. Yeah, this also came out in this report that came out about Libor. Was investigated. I think the Commodities Future Trading Commission, CFTC, put out a report, and yeah, they documented first of all email exchanges between different traders, Barclays traders and other traders, where they're talking about rigging Libor and helping out their buddies. So it might be somebody in Barclays took a hit on his own book and helped a buddy. Maybe it's his brother-in-law.
Make it through what, I'm sorry?
Maybe he helped his brother-in-law in a different bank.
Brother-in-law.
So, yeah, who knows what was going on here, or just friend, or girlfriend, or who knows. Anyway, Bob Diamond apparently had, even though these traders are acting this way and on the floor of this big trading floor and people can overhear it, Bob Diamond has no idea what's going on. He's sitting up in some top level suite getting reports from people below him, right below him. And this is the way corporate America works. If you're actually running a company, you want to be involved in the minutia of what's going on.
But how can you when there's such vast array of activities so no one person can be on top of everything? I mean, that's why you've got to.
Well, you set an example. You go and sit down next to these traders, and you find out, you get people to sit down. You change the entire culture, and that's how you change an institution. You make sure that none of this crap will be taken lightly, and you start firing people the minute you see it. You change, you make it clear to everybody that what's tolerated and what's not. So that's how you run a business. You are focused intensely on the details of what it is you're providing, and then that permeates throughout the corporation, and other people get that message, and then when they're managing other people, they act the same way.
So let me ask you a little bit more about this culture, because I've kind of got this image in my mind of what Oliver Stone's next movie might look like. You know, I mean, that is, it wouldn't be Wall Street; it would be, you know, what do they call it, the City of London or whatever. But there would be a bunch of, you know, the trading floor would be this really
Lombard Street.
This mad scene of screaming and shouting and people running around and all this pressure, and everybody's a 28-year-old wunderkind of one kind or another, and they're making hundreds of thousands of dollars a day, and they're going out and they're partying and drinking at night, and they're got all this testosterone flowing, and they're yelling at each other. We rigged the market. We setting the rate, man. You better get in on this, better get in on that. Did you see how that price just moved a minute ago? I knew that was going to happen. I knew that in advance. Blah 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 blah. Is it really like that? Have you ever actually been on one of these trading floors? Do you know any of these people who are, making $100 million a year doing this kind of stuff?
Well, not 100 million, but I've seen people. I know people that have made 10 million a year, 15 million, and I've been on the trading floors. Yeah. And a lot of what you just described is exactly, the first time I went into the trading floor at Goldman Sachs, I had one of the most disgusting experiences of my life. I saw this 25-year-old kid sitting there in front of all these screens with his sitting on his desk with his foot hanging down, and below him was this older black gentleman who was shining.
Oh man, yeah, right.
And I
was glad for the work too. I bet the tips are pretty good in there.
Yeah. And I wish I was younger, but if I had walked in there today, I would have said, what you're doing is disgusting, and you should get down and shine his shoes, because that was disgusting. But this is money is very much of an infection in some people's lives. They don't know how to handle it, and they think they're all powerful and that they can do no wrong, and that it's all properly earned, when in fact a lot of it is luck, and a lot of it is connections, and a lot of it is fraud.
Okay. So we're down in the weeds a little bit on the sort of rate rigging business, but why does it matter at the end of the day? Okay, there'll be some lawsuits. Particular financial institutions may take a hit. The value that their stocks are trading at may get suppressed as investors anticipate that Barclays or some other company may get smeared and hurt by the scandal. But in the larger scheme of things, what's the sort of deeper significance of this Libor brouhaha, in your opinion?
Well, it's just one of a whole series of banking scandals that have hit the industry since really 2007, when we started here. And a lot of this has to do with actual fraud, or perceptions of fraud, or perceptions of fraud. You had real estate deals that were in some cases shady in Ireland, and then you had Icelandic bankers borrowing like crazy from all of Europe and other places, promising rates of return on their deposits that they can pay, and then investing in crazy things all over the world. So they lied about being able to guarantee their deposits. Then you had Northern Rock and the Royal Bank of Scotland and the UK engaging in also very risky things in a very highly leveraged manner. And then you have the U.S. subprime crisis, where you have news comes out about liar loans and no-doc loans and ninja loans. And then, this concern about what's really going on inside of a market where people can't see, where the lights are turned off, where you can't tell what it is you're buying. Everybody decided to panic, and whether panic based on reality or or misperception or concern that other people were going to panic. They just fled the financial industry, and you had in effect a run on the financial industry. Not people trying to get their money out of their checking accounts, but people not lending to, not putting money into investment banks.
Because they lost confidence in the transparency of what was going on, because they believed that they were going to be defrauded somehow. I mean, I'm trying to link crisis to scandal. I know about financial crises, and I know about particular scandals. The Libor scandal of rate rigging is one, the liar loan, and aggressive marketing of subprime mortgages is another. But the crises are these things that happen when, the market is collapsing and everybody's afraid that all the investment money is going to dry up and that the real economy will be. Right. So I'm trying to get a link between scandal and crisis.
Well, think about Bear Stearns, right? They lost a couple of their big hedge funds. They weren't actually even part of their own company formally. Went down in June 2007, and there was a lot of concern about the quality of the loans they'd made and who was running it, and who was running Bear Stearns. The guy running it was Jimmy Kane, who hadn't even graduated college, and he was reportedly smoking dope and playing golf and bridge when he should have been covering his business.
Well,
anyway,
you can smoke dope and cover your business, I'm told, but that's okay.
Yeah. Maybe you do a better job of it, but
the problem was that he was at bridge tournaments. The way I read the book was he was at bridge tournaments when he should have been at home making sure that everything was okay. And,
yeah, absolutely. Yeah,
I don't know if he was smoking dope at those bridge tournaments, but in any case, he wasn't in New York City where he needed to be.
Yeah, so he didn't quite have an ace in the hole there. So Rome was burning down. He was fiddling at the bridge table, and meanwhile, from one week to the next, Bear Stearns' stock price goes from $57 a share to $2 a share. The whole thing collapses. And why is that? Because, people have heard enough bad things about Bear Stearns that they think other people are going to run on Bear Stearns.
No, so far, no scandal here, just perhaps some negligent management, but in any case, a loss of confidence inducing a crisis. I'm searching for the link between scandal and crisis.
So here's the thing. If Bear Stearns needs a certain amount of capital or investment money into it to keep operating, and if I think about investing, I know that my investment is only going to pay off if you invest as well. If you lend money, I'm willing to lend money. But if I think you're not going to lend money, I don't want to lend money. And if you think I'm not going to lend money, you don't want to lend money. So we have what you I would call multiple equilibria.
Yeah, where we both lend or where neither of us lend. Those are both equilibria.
Yes, and you see this going on in Spain today, and you see it in Italy and Greece. Nobody is lending to these countries. The domestic citizens are trying to pull their money out rather gradually, but the richer Spaniards and Italians are moving their money into German banks and other banks, or even U.S. Mutual funds. And I've got a good friend who's an Italian professor who's moved his entire bank account, from what I understand, into a Fidelity fund just recently. So this is the it's one thing if you could actually see what the banks are doing with your money, but if they're keeping that secret, then that's a very difficult kind of market. I think about, as an analogy, I'd like to tell about this Tylenol scare that happened in 1982, where you had
somebody put some cyanide or something into some Tylenol capsules that ended up getting sold off the shelves of a dispensary, and customers were hurt by it. And then once it hit the news, it became a life-threatening reputational hit for the Tylenol company. Right. And they had to respond to that.
Yes, and this happened in Chicago. 4 bottles out of 30 million bottles worldwide were contaminated. Now, more might have been contaminated. Nobody knew for sure. It's like some of the subprime mortgages are fraudulent, but nobody knows how many. So what happens after a couple of days, 7 people are dead. The 4 people that bought the Tylenol, and then their friends and relatives who came and saw them lying dead in their apartments, they grabbed the Tylenol to relieve their discomfort, their headaches or whatever, and then they died.
True story. I didn't know that.
7 people. Yeah.
Someone comes to the apartment, finds their dead relative, gets a headache, takes the Tylenol, and then keels over. I didn't know that.
Yes, sad but true.
Yeah, that's terrible.
And
your point here is that the fact that people, just a little bit of uncertainty about the quality of this product caused the whole market for it to collapse. Do I anticipate correctly?
Exactly, because you have all this opacity, nobody's noticed what they're buying. So it's a market, it's faith-based.
Likewise, with respect to banking, the fact that we have not got a clue about what these institutions are actually doing with the money creates the possibility for the least little rumor, a little tick one way or the other to drive people away as they fear, and as they fear that others will fear, that the institution that's become tainted slightly will collapse, and that becomes a self-fulfilling prophecy.
Yeah, I refer to this as faith-based banking.
Faith-based banking.
When the faith goes, when that goes away. So, in the Tylenol case, they had these 30 million bottles worldwide worth $100 million. And from 1 minute to the next, or one day to the next, there was no market for any of those 30 million bottles. That was a real price drop. That was a real toxic acid, if you will. And so what did Johnson & Johnson do? Well, they didn't try and shore up that market in one way or another and continue to allow the opacity. What they did is the government stayed out of it, and Johnson & Johnson had to recall.
They pulled everything off the shelves, and then they reissued the same product, but in a tamper-proof packaging format.
Exactly. That's where safety seal containers came, and that's why we can't open anything anymore.
And you're suggesting that, by analogy, some such transformation of banking practice could take the crisis-inducing uncertainty and non-transparency out of the business of borrowing and lending money?
Yeah, exactly. By putting on safety seals, that was really an active disclosure. You're disclosing for sure that what's inside those bottles is Tylenol. It's not cyanide. So it wasn't really the problem of selling Tylenol with cyanide, because you might want to use that to kill rats in a humane way or something. But the real problem was marketing Tylenol with cyanide as as Tylenol. So you need to have disclosure. The banks are operating with total proprietary information, total opacity, and then they're leveraged. So Bear Stearns was not in a position, if people started taking their money out, they had to sell their assets to meet the demands in a fire sale, and that wasn't enough to cover their liabilities, and they went under. So it's the combination of opacity and leverage, and this is something that we've had lots of discussions of the banking crisis, but to me, most people are pointing the finger at the wrong thing. They're saying, well, it was the Fed that did it, or regulators, or irrational exuberance, or a bubble. But it was really something endemic. We have basic fragility, and it's built into this financial system. It's built to fail, and it's unsafe at any speed.
This is interesting, Larry, because I think I'm now understanding your argument. You've been making this argument for a number of years. Your book, Jimmy Stewart is Dead. I'm sorry. What is it, Mr. What's the book?
No, that is the name of the book. Jimmy Stewart is Dead, because I'm saying we can't rely on
trustworthy banking, right?
Like Jimmy Stewart.
And I think I'm only now beginning to understand it. You're saying leverage plus opacity is an invitation for disaster because it leaves us with a kind of tripwire instability in the financial system, such that since we can't see what's going on, the least little hint or rumor of something wrong sends everybody for the exits. But combining that with leverage means that those highly leveraged institutions, when people do head for the exits, are subject to failure, because they can't meet all their obligations at the same time. So that leaves the system unstable, and only a system. This is not about bad character. It's not about greed. I mean, there may be some bad character and some greed around the edges, but it's a structural problem in the way in which banking is organized, given the fact that it's very hard for investors to know exactly what's going on inside these highly leveraged institutions. Am I getting it?
Yeah, perfect. I mean, look at Spain today. I've talked to hedge funds and different hedge funds around the country. I've talked to directors of the European Central Bank. Nobody seems to know the details of what the Spanish banks actually owe and own. Nobody can really look at their book carefully because the Spanish banking laws prevent that. So nobody wants to invest if they think that the banks might actually be in much worse shape than they're advertising. You know,
Yeah.
The difference between the book value of these banks and their market value is enormous these days. So that right there is saying that the market doesn't trust the record keeping, the reporting.
Hold
of
on.
banks
I
in the
think that
financial
needs to be
sector.
emphasized. The total value of the shares of the banks that are, as they're trading, is significantly below the aggregate value of the assets net of liabilities that the banks hold. Isn't
As reported at book, yeah, that's called the book
yeah,
value.
the book value,
Yeah.
which is the aggregate net value of the assets of the bank, is in excess by a substantial amount relative to what the shares of the bank are actually being valued at by the market. And you're taking that as an indication that the market doesn't somehow trust that the assets are really as valuable as the banks are reporting them to be.
Exactly. This is a measure of the concern about lying. This is one measure of fraud or potential fraud right there. And it's big from what I understand. So how do we fix this is the next question you're going to raise, I'm sure. And the answer is the same way we fixed this problem in the drug industry. In the drug industry back in 1900, people were selling medications with uranium or arsenic. They were sold as cures for cancer and other kinds of problems. And then, fly-by-night drug dealers, drug companies would sell this stuff, people would die, and then they'd, that would be that. So enough of this happened so that I think it was, forget exactly the origins of the Food and Drug Administration, but exactly who set it up, under what administration, but it was set up. And now you know that if you're going to take a medication for cancer or anything else that's really serious, it's going to have been tested clinically. So the government is actually coming in and verifying the product. That has to be done in the financial services sector. All the securities that the financial services sector are buying and selling to us need to be verified by an independent government agency that hires companies that work just for it, so there's no conflict of interest. And we saw with S&P and Moody's and
these are the rating agencies on the subprime mortgage paper who gave A ratings to stuff that was really not worth the rating, but they did it because their bottom lines depended on business that they got from the very banks whose assets they were rating. And we're going to get around this by having an independent evaluation agency that will...
Federal Financial Authority, yeah.
Well, I can...
Okay.
So one part of your suggested fix is to create an oversight agency and not allow financial instruments to be sold to the general public until their quality had been certified by an independent agency. Again, am I...
Right. This would be called the Federal Financial Authority, and they would
FFA.
verify FFA. Yeah, they would verify all the details. So, for example, right now, Glenn, if you wanted to take out a mortgage, you could sit down with an Angelo Mazzillo. He ran Countrywide Financial into the ground, and you and Angelo could lie about how much money you make and whether you have a job, and what the appraised value of the house is that you're going to buy, which is really collateral. And Anthony can issue you this mortgage and then sell it off to some unsuspecting Germans or Norwegians. That's the kind of market we have here. So I'm saying, look, there are simple things that need to be verified in this security, namely, do you have a job? How much do you earn? What's your credit history? And what's this house you're going to buy really worth? That can all be done by a government agency, sometimes without even, terms of your income and employment, they can just look at your W-2, your the data that's being sent to them electronically by Brown University. So there's some very basic things that can be verified very simply, and we don't have to trust people that are potentially going to lie to us.
Are you going to have a federal agency looking over the shoulder of every transaction between a bank and a mortgage borrower to ensure that the borrower's financial position is actually a state? That sounds pretty intrusive.
The way it would work is that if you wanted to borrow money on a house, your paper, your mortgage would be processed by the Federal Financial Authority. They would verify that you've got a job. And again, the entire private companies work just for it. And they verify all these basic things very simply. And then they would put this information up on the web. And then your mortgage would come up to auction by the new banks that would exist in my world, limited purpose banking world. And I call it limited purpose banking because under this proposal, banks would be limited to their legitimate purpose, which is intermediation. It's not borrowing money and gambling with it, but it's just connecting borrowers and lenders and savers and investors.
Can I just stop you here? Because one thing is the FFA, which is going to
FFA, Federal Financial
FFA, which is going to vouchsafe the quality of financial instruments. Another thing is limited purpose banking, and I just wanted to try to keep them separate, and which is going to restrict the set of activities that banks that get, I assume it's insurance deposit protection.
Well, limited purpose banking does two things.
Yeah. But I wanted to talk about one of them at a time, and I wasn't quite finished with the Federal Financial Authority. And the question I want to ask you about it is, if there's $600 trillion estimated volume of assets out there in the derivatives market, that's an awful lot of contracts between an awful lot of entities, individuals, corporations, banks, or whatever. This Federal Financial Authority is going to have its hands full, isn't it, in being able to certify that every such derivative market is, selling paper that is, of sufficiently high quality. It's going to have a huge staff. It's going to be working 24/7 all the time, and it's going to slow down. I think it's going to slow down the introduction of newly innovated financial products, which will have to wait for the FFA's approval in a backlog of cases, et cetera, et cetera. So,
it's actually quite the opposite. It's going to make the system much more streamlined and let people, small businesses like I have a small financial planning software company, borrow money or issue equity in a much more efficient way. It's going to make this allow derivatives to operate much more efficiently. And so here, let me just say the limited purpose banking has two main features. Its objective is to get rid of opacity and get rid of leverage. And it gets rid of opacity with the Federal Financial Authority. It gets rid of leverage by making all the banks change the way they're operating and operate in one way, which is in the form of mutual fund holding companies. So a Citigroup has to become a mutual fund company that does one thing, which is to issue mutual funds that are not leveraged, that don't borrow.
Okay, I give them my money. They invest the money in stocks, and I now own a share of the fund, which is a portfolio of stocks, and it's like
it's not
dollar
just,
for dollar.
Stocks.
It's 100% capitalized.
Well, yeah. I mean, Citigroup would, just like Fidelity Investments and TI Craft, Citigroup already has mutual funds, I'm sure. So the way a mutual fund works is that you put your money in, and then and you get back shares to the mutual fund. So the mutual fund isn't borrowing any money. It's not promising for sure to pay you anything back. And then they take the money and they invest in things. Some of them invest in stocks. Some will invest in government T-bills, treasury bonds, or treasury bills. Some will invest in European stocks. Yeah. So there's 10,000 mutual funds right now in the country. In the U.S., we have 10,000 mutual funds. About 75% are equity financed, and they're investing in all kinds of things, including mortgages. So somebody would fund your mortgage, Glenn, in this way. They would buy shares of Citigroup's mortgage mutual fund, and that mortgage mutual fund would buy your paper. But people would be able to go online and see that, hey, I bought this mutual fund. It's holding Glenn's mortgage, and I can go online and look at all the details of your mortgage, not your name, but hey, this is a house in Brookline, Mass. It's valued at this amount. This is a guy who's got this income, and it's been verified, and this past history of income, and this credit rating. And then they can understand what it is that they're buying inside this mutual fund.
Okay, so the fund is not
so
opaque.
It's not very simple.
I know exactly what the bank is holding. Finally, I know.
Right.
But if I'm getting rid of opacity, why do I need to get rid of leverage? I thought it was the combination of the two things that created the problem.
Well, because there can be shocks to the system that don't involve fraud or concerns about fraud. It could just be that some particular sector of the economy or large sector, we have a big recession. Why do we want the financial system to collapse? If the banks are leveraged 33 to 1, which is what Basel III allows them to be leveraged. I mean, they used to be leveraged 50 to 1, or some of them were. Lehman Brothers might have been leveraged 50 to 1 before the crash. Now they can be leveraged 33 to 1. That means that your assets only have to lose about 3% of their value for the bank to be underwater. This is absolutely insane to maintain the system. Now, the bankers are in bed with the politicians. The politicians are, and the regulators are trying to get jobs with the bankers. So the whole thing is, what do we want to call this?
It's corrupt. I think the word that you would want is corruption. And I'm thinking here that
it is corruption.
If there weren't a safety net implicitly lurking in the background, the bankers themselves wouldn't want to be leveraged 50 to 1, because if there weren't a loss offset somewhere, if when everything went down, people didn't still get to go home with their assets, they would never put themselves in that position in the first place.
Exactly. So the line in the sand with limited purpose banking, with Glass-Steagall, they have this phony line between investment banks and commercial banks, and what you call yourself determines what side of the line you're on, and you can just change your name and jump over the line when it suits you, which is what happened in the last crisis. With limited purpose banking, the line in the sand is between financial companies that want to have limited liability and those who are willing to operate with unlimited liability. If you want to have limited liability, if you want to be protected personally, if you want to own a bank and not have to worry about your own house being taken away if your bank loses money, you have to operate as a corporation you want to have limited liability. In that case, you have to operate in one way only, which is as a mutual fund holding company. And then you're issuing these, in effect, setting up these little banks. Each of these little mutual funds is like a bank, a little bank that borrows money, doesn't borrow money, sorry, it's 100% equity financed. And, so you can have Citigroup be broken up into a lot of little banks without actually breaking up Citibank. So when Sandy Weil the other day, who used to run Citibank, said that it should be broken up as well as all the other big banks, that was really not on target. What we really need to do is make them mutual fund holding companies. And then we're breaking up the banks by not breaking up.
I think this point needs to be explained, Larry. I'm not following it exactly. Sandy Weil's suggestion that Citibank is too big and should be broken up is not adequate to the problem that we face, because the smaller entities created by breaking up Citibank would still be limited liability corporations, highly leveraged and engaging in activities which, if they were to go bad, would leave the taxpayer holding the bag. Right. And it doesn't matter that they're big or that they're small. What matters is that they have limited liability, but they're able to place bets that put the aggregate situation at risk.
Exactly, and they're still able to operate under his proposal with opacity, with secret keeping. So he doesn't have his finger on the real problem. It seems like I don't know why it's so hard for people to see through what's going on here and see that it's really the secret keeping, the proprietary information, and the leverage. You get rid of those two things, you'd have no banking crisis in Europe right now, and you'd have no crisis with the euro but we can come back to that. But anyway, you have also under limited purpose banking, banks that want to operate on the other side of the line with unlimited liability as partnerships or proprietorships. In that case, they can borrow. But if they do borrow, they're going to lose their shirts. If the bank loses money, then the owners will potentially lose
everything they've got,
money they have personally. So it's exactly what you just said. We need to make sure that if anybody's borrowing and putting the economy at risk, they have to pay for it personally. Now, why did I say the economy at risk? Well, the reason that banking is special, it's different from the wheat industry. We don't have crises over farms or farm corporations going under. That doesn't happen. The reason that banks are special is that they're actually providing a public good. They're running the financial system. They're setting up a financial market. They're running it. And we don't want people gambling with public goods. We don't want the financial highway system to collapse thanks to either crooked behavior of the banks or just mistakes by the banks or just their general gambling behavior.
So again, this is a point I think that needs more explanation. The wheat market, wheat companies do go out of business. Their shareholders do lose their money. Their creditors sometimes don't get paid. Okay, but that's just the ebb and flow of the way that the market works, and companies go out of business from time to time, and it's no big deal. Banks are different. Banks going out of business create financial panics or crises that affect the country broadly. And the reason for that is what? I mean, just so that everybody understands.
Well, they're highly leveraged, and there's this multiple equilibrium. So Greece, let's take Greece. Suppose that the big banks in Greece face a big run this afternoon where a lot of people just say they've had it, I want to get my money out before it gets converted into drachma. And so I want to get my euros out. So there's a run, and it's put on TV. Well, 5 minutes later, people are going to start running in the banks in Italy and then in Spain. Then it'll spread to Ireland and Portugal and then to Belgium and France and right across the ocean. That's why you've got the European Central Bank printing oodles and oodles and oodles, tons and tons, literally tons of money of euros to try and shore up these banks because they understand the fragility of the overall system. And why am I going to run in Spain if I've got a bank account? Well, if I think that you're going to run, then I think the bank's not going to be able to pay me off. And I know that the Spanish government can't print euros, so I don't know for sure that Mario Draghi is going to be able to cover my deposit. So I'm going to get my euros out. So it's again, multiple equilibrium. It's if everybody runs, I need to run. And by the way, even if everybody does run and the European Central Bank comes in and insures everything by paying out euros to everybody, well, people aren't going to want to sit around with all this cash, so money will become a hot potato, and we have hyperinflation take off.
Okay, I see that.
And then the next thing, by the way, is that anybody who didn't run, who said, I don't have to worry, my money's insured by somebody, even if that were true, they would get killed if they didn't run and get their money out because they need to buy something real like a computer or a car, something physical, because if there's going to be hyperinflation, getting their money out, getting their paper out.
It's not going to help them because it's not going to be worth anything because the guy who's guaranteeing them to get their money has to print money in order to pay off his guarantee, which reduces the value of anybody's money.
This is faith-based banking in its essence. You've got banks making promises they can't keep. Then you've got governments coming in to try and shore up the banks by making promises they can't keep. And then you've got supranational institutions like the IMF and the ECB and the Fed really making promises.
I think it's really important to emphasize here, Larry, that the reason that these governments can't keep their promises is not because they don't nominally keep the promise, but it's because when they nominally keep the promise, that is to say, pay back the dollar, they do so in a way that reduces the value for everybody of the currencies that they're holding.
Right. They're in effect telling people, we're going to pay you back cans of soup. You've got your money now in our bank, in these banks, it's worth so many cans of soup, and we're going to pay you back cans of soup. But then if there are these runs, if push comes to shove, people say, well, we don't trust you, give us our money. People get their piece of paper, but they won't be able to buy any cans of soup. The Fed, as far as I know, you can go down to, I've been in the Federal Reserve building in Washington. There are no cans of soup there.
Yeah.
There's a lot of money.
All are dollars that you can get, but who can say what you'll be able to buy with those dollars?
I recommend that everybody who's listening to this podcast do something slightly illegal. It might be, I'm not even sure whether it's illegal, but they take a dollar bill and rip it up, just for the experience of understanding that this is just paper and how easily it can be destroyed. And I do that when I teach courses at BU about financial issues or money banking. I start out the semester by taking a dollar bill and I say, "What is this?" And,
yeah, I know.
What can you get with this? And I rip it up, and the kids get upset.
Yeah,
but it makes point.
It's money is an amazing thing. I agree.
You mentioned, it's very very fragile financial.
Rooted in intersubjectivity. Here, I've got a suggestion for you. Because it seems to me that the difference between the wheat market and the banking market is not that banking is a public good in the literal sense of the term, but it's that the character of the private good that banking traffics in is susceptible to this intersubjectivity problem. I mean, that stuff is worth only what people think it's worth, right? And if enough people don't think it's worth something, then in fact it objectively is not worth something. And there's nothing anchoring that system at all. Yeah. It can go all the way down. Whereas at the end of the day, wheat is worth whatever the ability to make a loaf of bread and eat it is worth. And that's an objective thing that is anchored in reality. Yeah. It seems to me that that's the key.
Yeah, well, I think there's more than one there's more than one public good involved here. And you just put your finger on a very important point, which is that money itself is a public good. If everybody believes everybody else is going to take it, then it's used in commerce and no problem. But think about 1864 Confederate dollars. Everybody started seeing that the South was losing the war, and people didn't want to take those things, and you had hyperinflation in terms of Confederate dollars. Not worth a continental is an old expression about continental inertia during the Revolution. So you can have everybody flip. Everybody decides the dollar is not going to be worth anything. They make the dollar not worth anything. And so it is very fragile. And this fragility, this mold of equilibrium, has never been discussed in public. You don't have the president or Mitt Romney discussing this. I mean, it's like, gee, the most important things about this financial system aren't being discussed, except by you and me on your show. That's why your show is so terrific. But let me say one other thing about
close it out. Go ahead.
About how you can run safely a derivatives market using mutual funds under limited purpose banking. So suppose we wanted to have a bet on whether or not, let's say a big company's bonds like IBM's bonds were going to default over the course of the year. Well, we could set up what's called a closed-end mutual fund where everybody puts their money in, let's say January 1st, and a year later, so the money's put into a pot, and some people are going to put their money in on the basis of IBM defaulting, and others are going to put it in on the basis of IBM not defaulting. A year later, IBM either defaults or not. If you bet that it would default, you're going to get, you and others who bet that way will get the pot less the fee that's charged by the mutual fund in proportion to what you put in. Now, that's people betting in a derivative way because bet is derived from what happens to IBM's bonds.
My position depends on IBM one way or the other. I can hedge myself by engaging in this market that you're describing.
And the mutual fund is not leveraged. All the money is right there on the table. It's right there on the table. It's a perfectly safe way of running a horse race. Now, the reason I say a horse race, so horse A here is IBM defaults, horse B is it doesn't default. This is pari-mutuel betting, which has been in place since about 1857 in the horse tracks all around the world. I've never heard of a horse race where any taxpayer was put on the hook for paying off the loser. So we have these ancient financial institutions that we can look to come up with the right answer. In-trade actually is a derivatives market. It's, for example, you can bet on whether Mitt Romney or Obama is going to win.
No, I
it's
did
very
it,
much set up.
Can you help us a little bit by telling us, so what would a leverage situation look like in the pari-mutuel example? What would be the, as it is now, there's somebody on the other side of every bet, and it's dollar for dollar. But how could it be run in a different way?
Well, if the mutual fund that was organizing this went out and borrowed another, a huge amount of money, and then, let's say, invested in and then bought, maybe they invested that money in some asset that lost value, and now because they thought it was a great investment, but it lost value. Now they have to pay off the guys. IBM defaults. They're supposed to pay off the guys who won the IBM defaults bet, and they don't have the money because they just.
So the analogy would be that if at the track, when I go to the window and I put down my $2 on, somebody to come in, they took the money and they went on and engaged in some other betting activity, and their ability to pay me off depended on whether or not they were successful in their own gambling.
Yeah, look at AIG. This is exactly what they did. They sold insurance against companies defaulting, especially real estate companies and so forth. And then they took the money and they invested in subprime mortgages. So they doubled down. And so the insurance companies are running leveraged insurance. They've got underneath the hood there is a huge amount of leverage, just like within the banking system. So that's why every financial company, whether they call themselves an insurance company, a hedge fund, an investment bank, a commercial bank, under limited purpose banking, they all have to operate in one way only, which is as a mutual fund holding company that issues unleveraged mutual funds, one of which, by the way, is going to be a cash mutual fund that holds just cash. I'm talking about just pieces of paper, cash, currency, and that mutual fund will be used for the payment system. And that's the only mutual fund that will be back to the buck. Money market funds today are leveraged, and they're about. I'll just say this last thing, and then I know we probably need to close up. But the reason we had trouble with the money market funds in the crisis is that they were the only part of the mutual fund industry that was leveraged. In what way were they leveraged? Well, the money market funds took in money, and they promised that nobody could lose money. They were saying that they were back to the buck, and that was a false promise. They couldn't actually cover that promise. That's the sense in which they were leveraged. And that's what promoted a run on the mutual funds, the money market mutual funds. And that's why the Fed had to come in and insure them to the tune of $3 trillion. And that was the size of the market. In about 15 minutes, they had to issue this insurance obligation. So the taxpayers, over the course of 15 minutes, U.S. taxpayers, with no vote by Congress, suddenly had a $3 trillion liability that they didn't vote for. So this is the nature of leveraged banking. We have to get it. We have to have no opacity. We have to have disclosure, and we have to have equity financed intermediation, and we're all set. We'll never have a banking failure again in the history of the country.
From your mouth to God's ears, my friend.
Right. Yeah.
I said from your lips to God's ears on that one, my friend.
Well, it can be done. All we need is to have one country, one small country or one big country, set an example. It'll be the model, and it will spread. So let's.
It occurs to me that take the leverage out of banking, and you also take the deleveraging out of the downside of the business cycle. That is, that there could be implications for dampening the ups and downs of general macroeconomic activity by defanging the financial sector and making it more stable.
Right.
So.
Yeah, if you look historically at all our major recessions and depressions, not all of them, but a large fraction of them have involved banking crises, including the 30s, obviously, where a third of the banks failed. So I think banking is actually a form of a major source of macroeconomic instability. If we get to limited purpose banking, we'll have a much safer economy, and then we can actually do our business, which is producing things that people actually need. So banks can be made safe, and this is the way to go.
Yeah, me so, Larry. In any case, thanks for coming on the Glenn Show and talking about this. It helped me a lot to understand what's going on. I appreciate it.
Well, thanks so much, Glenn, for Great for
Okay,
doing it
so
with
we'll
you.
talk again sometime.
Absolutely. You take care.